Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Samsonite Group S.A. Annual Report. The Samsonite Group S.A. offers a diverse range of businesses and services that cater to various needs of its customers. The company's primary focus is on designing, manufacturing, sourcing, and distributing luggage, bags, and travel accessories across different regions including Asia, North America, Europe, and Latin America. Under its umbrella, Samsonite Group S.A. operates several well-known brands such as Samsonite, Tumi, American Tourister, Gregory, High Sierra, Lippalt, and Hartmann. These brands provide a wide array of products that cater to different customer segments, including business professionals, travelers, and outdoor enthusiasts. In addition to its product offerings, the company also provides distribution services through various channels, including wholesale distribution, retail stores, and e-commerce platforms. This allows customers to purchase Samsonite's products conveniently and easily, both online and offline. Overall, the Samsonite Group S.A. has established itself as a leading player in the luggage and travel accessories industry, with a strong presence across multiple regions and a diverse portfolio of brands and services. Samsonite Group S.A. market capitalization of $21 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Samsonite Group S.A. holds a significant advantage in their industry. Samsonite Group S.A. trades at a higher price-to-earnings ratio of 9 times and a higher price-to-book ratio of 1.8 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 5.59%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Effective marketing support and projected growth in the travel industry have led to an increase in penetration of core brands in markets, driving revenue growth. Additionally, the direct-to-consumer (DTC) channel has experienced significant growth due to increased wholesale net sales to e-retailers and continued investments in digital marketing and e-commerce. The TUMI brand has also seen robust travel demand, particularly in Europe, contributing to revenue growth. Furthermore, a shift towards higher-margin brands, product lines, and channels has led to an increase in net sales of the TUMI brand due to strong demand. On the other hand, several factors have contributed to revenue decline. Macroeconomic uncertainty and shifting trade policies have resulted in cautious purchasing by key wholesale customers in North America, leading to a decrease in net sales. Lower consumer confidence, particularly in Mexico, has also had an impact on revenue. Changes in product and channel mix, as well as foreign currency exchange rates, have further contributed to revenue decline. Regional performance has also been affected, with Asia experiencing a decrease in net sales due to macroeconomic uncertainty and shifting trade policies. North America has seen a decrease in net sales due to lower inbound tourism and cautious purchasing by wholesale customers. In contrast, Europe has experienced an increase in net sales driven by robust travel demand and international travel to the region. Other factors that have impacted revenue growth or decline include seasonal fluctuations due to increased retail activity during summer travel and holiday seasons, as well as global economic and political uncertainty affecting consumer confidence and spending habits. Tariffs and trade policies have also had a significant impact on net sales, particularly in North America. Net income decline. A tale of uncertainty and tariffs, the company's net income took a significant hit, decreasing by 16.1% from $300 and $72.6 million to $312.5 million. This decline was also reflected in the adjusted net income, which dropped by 20.7%. The reasons behind this downturn are multifaceted. Global economic and political uncertainty led to reduced consumer demand, impacting sales and subsequently net income. Furthermore, increased product costs due to U.S. tariffs added to the company's woes. However, there was a silver lining. A favorable net sales mix in higher-margin regions and channels helped mitigate some of the losses. Profit margins also felt the pinch, with gross profit margin decreasing by 0.4% from 60% to 59.6%. The operating profit margin is not explicitly stated, but its decrease was mirrored in the 16.1% drop in operating profit. Adjusted EBITDA margin took a hit of 1.7%, falling from 19% to 17.3%. The combination of reduced consumer demand and increased costs resulted in a decline in net income and profit margins. While some regions and channels provided a temporary reprieve, the overall impact was significant. The company's financial performance indicates a stable trend in its ability to generate positive operating cash flow. Despite a slight decline of 10.4% from the previous year, the net cash generated from operating activities remains substantial at $506.3 million in 2025. This decrease is not alarming, as it suggests that the company is still capable of producing significant cash flows from its core operations. Overall, this indicates a healthy financial position for the company. The company's debt level and interest expenses have undergone significant changes over the past year. One notable decrease is in total debt, which dropped by $30.7 million, 1.7%, from $1,778.9 million in 2024 to $1,748.2 million in 2025. Conversely, there has been an increase of $0.5 million in interest expense on loans and borrowings, from $95.5 million in 2024 to $96 million in 2025. However, finance costs have seen a more substantial decrease of $32.6 million, 21.5%, from $152 million in 2024 to $119.4 million in 2025. The company's debt level may also be affected by changes in amortization schedules and interest rates, which could lead to an increase in interest expenses. Despite these significant changes, there are instances where no notable changes were mentioned. Interest expenses remained unchanged at $119.4 million in both 2024 and 2025. Overall, the company's debt level and interest expenses have undergone fluctuations over the past year, with some areas seeing decreases while others experience increases. Management is optimistic about the company's future, citing strong global demand for travel as a key driver of growth. They plan to capitalize on this momentum by executing strategic priorities, including amplifying iconic brands, becoming the clear winner in digital channels, and seizing whitespace opportunities. The company will continue to invest in product innovation, marketing spend, and operational execution to drive net sales growth. Management is confident in their ability to execute on their strategic roadmap and navigate headwinds such as global economic uncertainty. They believe that their diversified sourcing platform and scale advantages will help them manage through these challenges. In the long term, management expects significant benefits from renewed consumer demand for luggage and travel bags. They plan to increase marketing, spend to drive growth, and aim to create a path towards a more sustainable future for the industry by investing in innovation and developing high-quality new products that address varying consumer preferences. Management also emphasizes the importance of balancing investments in marketing with cost discipline and profitability, while continuing to grow sales in established and emerging markets. They intend to upgrade and expand their retail store fleet through strategic investments in property, plant, and equipment. Overall, management's strategy focuses on amplifying iconic brands, winning in digital channels, and seizing whitespace opportunities to drive sustainable revenue and earnings growth. The company has made several strategic moves through acquisitions and divestitures in recent times. On the acquisition front, the company has purchased TUMI and Gregory, two notable brands that are expected to enhance its portfolio. In terms of divestitures, the company has taken steps to optimize its operations and reduce debt. One significant move was the repayment of €350 million worth of senior notes due 2026 in November 2025. This not only reduced the company's debt burden, but also freed up capital for future investments. The company has also issued new senior notes with a higher interest rate, indicating a shift towards more cost-effective financing options. Furthermore, it canceled 79 million treasury shares, which is expected to have a positive impact on its share price and overall financial health. In addition to these moves, the company has closed 64 of its retail stores, a strategic decision aimed at streamlining operations and improving profitability. These divestitures demonstrate the company's commitment to adapting to changing market conditions and optimizing its resources for long-term success. The company's financial activities have been multifaceted. On the one hand, the company has demonstrated a commitment to returning value to its shareholders through dividend payments. This indicates that the company is generating sufficient profits to distribute a portion of them to its investors. On the other hand, the company has also engaged in share buybacks, which suggests that management believes the stock is undervalued and presents an attractive opportunity for long-term growth. By repurchasing shares, the company can reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting the stock price. That concludes the financial summary for Samsonite Group S.A. Feel free to comment below, and I will be happy to answer them when possible.